5 huge mistakes I see beginners in the stock market make every single year. If you are newer to the stock market, meaning you're in your first year of investing, okay? Maybe you've been looking in the stock market for a few weeks, a few months, or whatever. You've been in the markets for less than a year. There's a good chance you're probably gonna make at least one of these mistakes, and I'm here to present this video for you guys here today that hopefully you do not make any of these mistakes because you watch this video, and I hope it helps you out and whatnot. Now, I made some of these mistakes, and almost every single investor gets caught into at least one of these. And these things can waste so much of your time, your energy, and your money in the end if you get caught into them, guys. So I hope you enjoy this. Hope you get a ton of value out of it. Make sure you follow me on Instagram and Snapchat. My links are down there in the description. Let's get into this, guys. The first one is buying a stock just because someone else you heard is buying that same company. Just because someone else believes in the company does never means you should buy those shares. I don't care how much you respect them. I don't care how much money they have. I don't care how much success they've had in the past. You should never, ever, ever buy a company just because someone you might look up to is also buying that company, okay? Now, it is fine if you hear a stock idea from whoever, your neighbor, your dad, the guy online, me, Warren Buffett or Carl Icahn or whoever it is. You hear a stock idea and then you're like, that one seems kind of interesting. I'm going to look further into that. That's okay. And then if you invest and you looked into the company and whatnot and you really liked it, that's fine. You get my blessing on that. I do that all the time. I'll hear someone else mention a name, and most of the time, 99% of the time, their names I'm not interested at all in even looking into. Sometimes I look into them and they don't even really get past like a 1 hour mark. And that just happens. But the majority of my investments, the idea came from somewhere. Like maybe I read an article online about this stock and I'm like, oh, I need to look into that. Maybe I'm watching TV one day on CNBC or Bloomberg, or I see something on a CNBC app, or I'm on the stock tracker app. Somehow that idea came to me, right? It's not like I just sat in my room and I just like thought forever, oh man, let me just think of a magical stock here. I had to hear an idea from somebody, or maybe somebody mentions a stock in a comment, right? Maybe someone mentions in my stock market group. The idea has to come from somewhere, right? But there are 2 real reasons why you don't ever want to just buy a stock just because someone else is, okay? The first one's obvious, like they could get it wrong, okay? It doesn't matter who it is, they can get that stock wrong. So if you buy stock A, B, and C, and that happens to be one of them they're wrong on, you're going to lose money, okay? That's the very, very obvious thing. The second part is so much bigger than that, though. The reason someone gets into the stock market, other than obviously wanting to make their money into money, right? The biggest reason someone gets into the stock market is because they want to have financial freedom. They want to start taking control of their life, okay? As an individual stock picker, you are starting to take control of your financial life, right? So many people are so dependent on their job, right? They lose their job, they're screwed. Like they have to go find another one immediately and try to look around for that. And most people don't invest their own money. They just stick it in a 401k, whatever money they can put away, right? And it's invested automatically for them by some fund manager or something like that, right? So they have really no control of their financial life at all, okay? When you start individual stock picking, you begin to start taking control of your financial life, where you start making decisions in your life. I like company A, B, and C. I like this company over here. I like this company over here. I like these 5, 7 companies over here. I'm going to stick money in these. You start taking control of your financial life, and it begins to get you in a mindset shift completely, okay? Now, when you're just investing just because someone else you heard, you're still not taking control of your financial life. You do not take control of your financial life until you start making your own decisions, okay? Until you start being your own man, your own woman out there. Until you start making decisions for yourself, you're not really financially free. This is the first step. So you don't ever want to just buy a stock because someone else does, guys. This is number 1. Let's get into number 2. Number 2 has to do with making sure you fully understand that you are not going to make money on every single stock you invest in. This is so key, guys. I used to think when I was just getting started in the game, I would make money every single time, okay? It's just not accurate, guys. You're never going to make money 100% of the time. time over the long term. Are there some years where maybe you just knock it out of the park and every single one of your investments goes great? Absolutely, but there's going to be a time, if not multiple times, when you actually, lose some money, okay? So the way I like to look at it is there's a sport called basketball, okay? And basically if you get fouled or whatnot, you shoot free throws. And what I have found is the same exact statistics that go into shooting free throws are the same things that actually go into stock market investors as far as success goes. So if you are a great free throw shooter, if you shoot 100 free throws in a game, you should make at least 90 of those. It's the same exact ratio as far as successful investing. If you are a truly great investor, if you invest in 100 stocks over a 10-year span, at least 90 of those stocks should have made you money, okay? The game is totally rigged in your favor in the stock market. It's totally rigged in your favor over the long term, okay? And we can get into that just a little bit. If you are a good free throw shooter, 80% plus of your shots are made, okay? Same deal in the stock market. If you get at least 80% plus of your stocks are successful and you make money on them, you're good at the stock market. And then if your average is somewhere between 70 and 79% of the time your stocks are correct. So if you invest in 100 stocks over a 10-year span, at least 70 to 79 of those should have been a success, all right? Now, anything less than 70%, you are really garbage, okay? There are either one of two problems. One is it could be just your strategy is really, really bad, okay? So if you invest in 100 stocks over a 10-year span and only 65 of those make money, only 50 of those make money, especially if you lost money more than you gained, either your strategy is horrible or you're not putting in the work ethic, or you've got both problems going, right? Where you have horrible, strategy and you're not putting in the right work ethic. Same deal with free throw shooters, right? Some of them have horrible, technique and whatnot, and they never make their free throws and they miss more than 70% of the time. And usually those same exact ones, they usually never put in the work ethic to become a great free throw shooter, okay? So why is the game rigged in your favor? Well, one, the government is totally on your side, okay? The government wants the stock market to go up more. The government wants companies to be more profitable, okay? The government wants, companies to be able to compete internationally and things like that. So they're going to do things, whether it be a corporate tax reform, whether it be, lowering interest rates, whatever it takes to keep the economy solid, to keep these corporations going up. And most people have tons of their life savings in the stock market. So one day they would like to retire, right? The stock market goes up. Generally speaking, they can retire and do things like that and spend more money and whatnot. So the whole game is rigged in your favor. Also, you've got, very bright executives on almost every big company out there, right? Who are daily are trying to think, how can we make more profit? How can we expand into this category? How can we do this or that? The whole game is really rigged in your favor completely. That's why if you can't get it right at least 70% of the time, like your strategy is either really bad or, ultimately at the end of the day, you just might not be working hard enough. And once again, you've got to judge it over the long term, especially if you're a long-term investor. So if 1 year goes by and you invest into, let's say, 10 stocks and not at least 7 of them went up, that's 1 year. You're a long-term investor. Why are you judging off of 1 year? You should be judging off of, 3, 5, 7 years, whatever there. So that's number 2. Let's get into number 3. The number 3 mistake beginners in the stock market make, and I made this mistake in my first year, is looking at dividend yields, okay? Looking at the dividend yield and thinking you should make an investment based upon what a dividend yield is. So if you see a 2% or a 3% or 4% yield, all of a sudden you're like, oh, this company pays a 4% dividend yield. If I got $100 invested in this company, I can make $4 this year and just for having my money in it. And so a few things. One is just because a company has paid a dividend in the past doesn't mean it's guaranteed to pay it in the future, okay? They could cut that dividend. Now, with most bigger companies, they usually don't cut dividends. They usually keep them going unless maybe we go into a recession or something like that. Usually they keep that dividend, okay? But it's possible they could cut it. But also, there's no point in just looking at the dividend ratio and thinking that's going to help you be a successful investor or whatnot. That should mean absolutely nothing to you. Because, okay, you invest in this stock, it pays you out 4% in dividends. Awesome, okay? So you had, let's say $1,000 invested, you get $40 in dividends from that. Cool. Well, what if that stock has a bad year though and the stock price depreciates 20%. How bright of an investment was that? It's really not as simple as it is just like, oh, let me look at the dividend ratio and go from there. That's not how it works, guys. Last year, the stock market went up somewhere around 25, 26%, okay? The average dividend paid out there was probably somewhere around a 2% yield. What mattered more? If you were in a stock that went up 40, 50, 60, 100% last year, or the dividend yield you got that was a 2% yield or something on a GE stock or whatever that actually went down last year. Like, you got to think about this, guys. Dividend yield, don't get caught up into that too much. It's more about how much your company appreciates over time, how much more valuable those shares get, and that's, based upon what revenue growth is in the future. People base, what the company's doing in the future by revenue growth in the future, expect it. What the total sector they are in is going to do in the future. Is that going to grow in the future? And then also, what's that forward PE at? Is it super high already? Maybe it's already overvalued at that point. Is it low? Maybe there's some opportunity there, especially if there's growth. So don't get caught up in the whole, oh, this one pays a 3% yield or 5% yield, and this is what I need. That's not really where your focus should be. Your focus should be on making business decisions, on investing in stocks, not, oh, this one pays a 2% yield. Let's get into number 4. Number 4, this one, oh my goodness, I see this so often from newer people in the stock market, people that are within their first year of investing. It is getting so caught up into day-to-day price fluctuations in stocks. You should not be getting too caught up into, oh my gosh, stocks went down 2% today, stocks went up 2% today, whatever. Like that should not matter. Whatever's going on in that day-to-day, fluctuations in prices, it should not matter. Now, last year, for people that just, got started in the stock market last year, they kind of got started in a really bad year, in my opinion. It was a good year and bad year. Obviously, the markets did phenomenal, but from a psychological perspective, they came into a market that was just pretty much going up and was very, even and whatnot. There wasn't a ton of volatility. Now, this year so far, we've had a lot of volatility, especially here in February, right? The markets have been moving all over the place pretty much day in and day out. We're seeing 300, 400, 500 point moves, sometimes even 1,500 point moves, right? So there's a huge, picture the ocean, the ocean goes up and down. That's really what the stock market is, okay? So you got to expect that. If you go in the ocean with a boat, you better expect that boat's going to be rocking up and down, especially if you're in a storm, right? Same deal with the stock market. You cannot get caught up into, oh my gosh, the stock market went down or up. All that's just mumbo jumbo. You need to be making business decisions on investing in stocks and thinking several years out. Where is this company going to be 3, 4, 5 years from now? I don't care if I buy stock A, B, and C for $10 a share tomorrow, okay? I don't care what that stock's at 1 week from now. I don't even care what it's at 1 month from now, okay? Maybe I care in the respect that I might buy some more shares if it goes lower or whatnot, or sell off if it went up massively. But for the most part, I don't really care where those shares are at. Talk to me in 3 or 4 years. That is when I really care where those shares are at. So whether those $10 shares I bought went down to $9, went up to $11, went to $12, $8, I don't really care. All I want to know is 3 years from now where those shares at. Are they at $20, $30, $40, or are they at $5? That's really what I want to know at the end of the day, and that's really what I cared about. Don't get caught up in all those price fluctuations. It's going to distract you from where your mind needs to be, and your mind needs to be on looking into companies for the long term, not, oh my gosh, this one dropped a percent today, or 2%, or 5%, or whatever, guys. So keep that in mind. Let's get into the last one, number 5. This one, number 5, is really not just a mistake I see beginners in the stock market make. I see experienced investors make this all the time. So whether you're watching this and you're new to the stock market or experienced, I see this all the time. And it is truly people not caring about the balance sheet. People that just don't care about the balance sheet. And in most market situations, the balance sheet isn't going to be incredibly important, okay? The balance sheet kind of gets forgotten about. The balance sheet, basically, for those of you who do not know what a balance sheet is, by the way, I got video on what a balance sheet is and whatnot. Think of it in the simplest terms. The balance sheet of a company, think about it as a balance sheet of your life. The balance sheet of your personal life is how many assets do you have? How many liabilities do you have? How much cash do you have? How much money do you have in your savings account? How much money do you have in your stock market accounts? Do you own a home? Things like that. And then what are your liabilities? Do you have debts and things like that? It's the same exact idea, but for a company, it's going to be, what do they have for assets? What do they have for liabilities? You really need to be paying attention to the cash category. You really need to be paying attention to what they have in short-term investments, long-term investments, and then you really need to be paying attention to what that company has in short-term debt and long-term debt, okay? By looking at those, you can get a pretty good idea of where that company's financial base is, okay? Meaning, if that company comes upon hard times, or we have an economic troubles, okay? We have economic troubles, we go into recession scenario. What is the likelihood that that company is going to get through that and not go out of business, okay? Or you know, with some price protection there. A lot of people lost a lot of money in the 2008-2009 stock market crash in recession, right? Because they were in companies that had poor balance sheets. And some people weren't hurt nearly as bad in the recession that were in the markets because they were in companies that had phenomenal balance sheets. You get in companies that have weak balance sheets, and when something goes wrong with that company, and sometimes you're going to get in a company that something goes wrong with, things are going to go really bad for that investment. The only reason, my worst investment ever in my life as far as one particular stock goes, was GoPro. They messed up across the board. They made so many mistakes we don't even have to get into. They messed up everything. Everything they could have messed up, they messed it up, okay? This company, the only reason I was able to sell out my shares at like $6.50 a share rather than 50 cents a share or nothing per share is literally because that company had a great balance sheet. So when I went into that investment, I looked at the balance sheet, I looked at everything, I thought it was going to work out, but lucky enough, I cared about the balance sheet, and they had a ton of money in cash, they had a ton of money in investments, and at that time they had no debts. So they were able to get through all these troubles and whatnot, and I was able to sell out at somewhat of a reasonable rate rather than lose all my money that I had invested in that one, guys. And people lose all their money in some of these stocks they mess around with that, you know, don't have a great balance sheet. And next thing you know, they're having to sell out for bankruptcy type prices, and that hurts really bad, guys. You never want to lose that much capital. You're going to lose some capital once in a while, but you don't want it to be so extreme that, you know, one of your bigger investments went bankrupt or something like that. That's a horrible situation. A lot of people got caught up into that in the 2008-2009 recession. And a ton more people are going to get caught up into that in the next time we have a big recession, which who knows when it's going to be. But when we do, I can guarantee you a lot of people are going to lose the majority of their money, if not all their money, because they're going to be in some of these companies that have really poor balance sheets. Those companies are going to go under in a very rapid amount of time, and it's not going to be a good situation for them at all, guys. So make sure you're always paying attention to that balance sheet. Anyways, I hope you guys enjoyed this tremendously today. Make sure you follow me on Instagram or Snapchat. Links down there in the description. Anyways, thank you for watching, guys, and have a great day.